Good day, class. Welcome to the fourth session of Financing a New Venture. In this session, we will identify the requirements and processes to get the chosen financing option for a new venture. Entrepreneurs have great responsibility of having to satisfy customers, shareholders, trade creditors, and lenders. When setting up and expanding a business, you might need to make use of loans to improve or grow, which is why it is crucial to be capable of satisfying the bank or government-sponsored financing agencies. Or you will need to resort to raising money in the venture capital market, where a minimum equity capital is required. Lenders make use of a 5-step process to assess credit worthiness, which is character and integrity of the entrepreneur, capacity to service the loan, capital, collateral, and prevailing conditions. Aspiring entrepreneurs often come across an issue of running out of funds, borrowing money that they do not need, or even over-borrowing. These problems can cost the business and the entrepreneur's life savings. There are 3 questions that an entrepreneur can ask in order to avoid experiencing these problems. The first question is, what amount of funding is needed? It is rather not a success to acquire only a portion of the required amount and have the new venture fail due to the lack of funds. One could make use of a financial planning model in order to estimate the funds required by the business by making use of pro forma income statements and balance sheets. The pro forma financial statement estimate asset and financing requirements, as well as the amount of debt required to balance the project balance sheet. There are other methods that exist to help determine the amount of funding needed, such as percentage of sale approach, external financing needed formula, and the free cash flow approach. The second question is, where will the funding come from? Regardless of whether your business is credit worthy or not, you will lose profit. You will lose profits if borrowing while it has internal funds available in the form of excess working capital. Working capital includes cash, stock, debtors, and creditors. Let us break down some of these factors. Keeping excess stock can be dangerous for a new business due to interest costs, insurance requirements, warehouse space, and handling, which can result in stock getting damaged and obsolete, so you can try to improve the sales in order to make profit from the excess stock, and in return, funding your venture internally. In the perspective of a debtor, the more time you give a customer to pay results in tying up necessary funds and increases your chances of incurring bad debts. If your debtors are in order and you are still in need of funds, then you can resort to factoring. Factoring is a form of funding that is used to acquire debtors and generate funds by allowing the provider of the funds to buy the debtors from your business. This might be with or without resources to your bad debts. Credit cards are a form of factoring without recourse. From the perspective of a creditor, if you delay your payments to creditors, then it allows funds to remain in the business, and this reduces the need to borrow. However, this could put you at risk for losing early payment discounts, and you can end up being more expensive than an overdraft. The third question is, when will the funds be repaid? The funds used to service debt should come from future operating profits. After taxation, liquidating your pledged assets should be your last resort to service debt. It is also advisable to not depend on interest-bearing debt in order to finance your business. In general, lenders want about 20% to 30% of the total capital employed to come from the entrepreneur. and will require collateral to secure their loans. The lenders make use of pro forma financial statement scenarios or cash flow sensitivity analysis to determine whether you will be able to repay the debt granted. The greatest financial decision you will make is determining whether you will buy or lease your premises, which needs a lot of attention and planning. Determining beforehand whether you settled for purchasing or leasing before you actually start looking for the property can be very helpful. By doing so, you rule out premises that do not meet your criteria, and this can save a lot of time and unnecessary research. Acquiring funding from commercial banks is often not an option to entrepreneurs due to high security requirements, high interest rates, complications in the scheme, and complications in method of investment assessments. South Africa has a relatively strong venture capital market, despite a very poor venture capital market for Africa as a collective. In 2013, about 76.9% of the venture capital funding was related to the Black economic empowerment. Regardless of that, there is still a struggle with funding new business creation and improving the availability of low-cost access to finance for African businesses. The main challenge is getting access to capital that falls between banking rates and micro-lending rates without the complications of public fundraising listings. It makes sense to try and get a group of investors together to limit the risk of investment, but the challenge arises when trying to manage a large group of investors in equity schemes. On the other hand, banks require new ventures to have a proven track record of a year to 3 years, which makes it complicated to use the collective will of a group of people as security for a loan. Due to these complications, entrepreneurs resort to other means of funding, which would be saving, taking a loan, taking a second mortgage, getting contributions from a group of people, raising money through family, getting an angel investor, finding an early-stage venture capitalist that takes a higher stake while assisting the startup, and lastly, working through business incubators. All of the funding methods listed above have their own advantages and disadvantages, which is why it is crucial to investigate the real cost of the money that you are receiving. One should be aware of the hidden costs, such as interest, increases, and other factors that will have impact on investment. There are countless means to fund and grow your venture that you might not have considered due to them not being the conventional solution, but I recommend that you go through them because they may turn out to be the foundation of successful business. We have come to the end of our session. Let us take a break and we'll complete the unit standard in the next session.